Right now, across the country, grocery stores are making just absolute record profits on things like chicken and pork.
Right.
And then your local auto mechanic shops, I mean, they are busier than they have been in a decade.
Oh, yeah. Totally slammed.
But then, if you look just down the street, you've got mid-tier furniture stores and full-service casual dining restaurants staring at these terrifyingly empty parking lots.
Just ghost towns.
Exactly. And what looks on the surface like absolute chaos in the consumer market, it is actually this highly predictable systemic pattern, but only if you know which diary to read.
Yeah, and it really is all about reading the right leading indicators because, most real estate investors are completely trained to just look in the rearview mirror.
Right, like looking at old data.
Exactly. They look at CPI prints, they look at GDP numbers, or they, track last quarter's cap rates.
Yeah.
But by the time those official statistics are actually published by the government, I mean, that data is already history.
It's ancient by financial standards.
Right. It tells you what happened, not what is happening today. And it certainly doesn't tell you what is going to happen when, say, your tenant's lease is up for renewal in 6 months.
Which brings us to the core mission for today's deep dive. We are unpacking a really specific, just incredibly dense and high-value presentation.
Yeah, it's a great one.
It was prepared by Eureka Business Group, and specifically by their managing principal, Joseph Goslin.
Right.
And what Eureka has done here is honestly remarkable. They took the Federal Reserve's July 2026 Beige Book, and they extracted the absolute most crucial ground-level intelligence.
Yeah.
And they tailored it specifically for retail real estate investors.
Yeah, they really filtered out the noise. Now, before we get into the actual data, we should probably establish the mechanics of what the Beige Book actually is.
It's a good idea.
Because it's a very unique instrument in the financial world. I mean, it's published 8 times a year by the Federal Reserve, right?
Right.
But unlike the jobs report or, the inflation index, it is not just some spreadsheet of cold, hard, quantitative statistics.
No, not at all.
It is pure qualitative intelligence.
It's like the diary of the U.S. economy.
That is the perfect way to conceptualize it. The Federal Reserve has these 12 districts across the country, and ahead of their policy meetings, they literally send their people out into the field.
Like actual boots on the ground.
Exactly. They conduct actual human-to-human interviews with business owners, community organizations, economists, local market contacts.
Talking to regular people running businesses.
Right. And they aren't asking for balance sheets. They are asking things like, what are your customers complaining about this week?
Yeah.
Or what materials are you struggling to source right now? Are you hiring or are you freezing headcounts?
Oh.
So it captures sentiment in real time.
Okay, let's unpack this. Because if you are listening right now
Yeah.
and you allocate capital into retail real estate, I mean, whether
Yeah.
that's a strip mall or a standalone quick service restaurant or maybe a grocery anchored center, you have to understand why this matters to you.
Absolutely vital.
This document is the closest thing you get to a crystal ball. It signals these microscopic shifts in consumer behavior long before they aggregate into macroeconomic trends on a chart.
Right.
If you want to know if the tenant fits you rent today is going to be financially healthy tomorrow, you have to understand the actual people walking through their front doors.
Yeah, you have to know the consumer. And the overarching national theme that Eureka pulled from this July 2026 report is that, well, the economy is growing, but it is a highly constrained, moderate growth.
Constrained is the key word there.
Exactly. 11 out of the 12 Federal Reserve districts reported expansion. So we are seeing modest growth in loan volumes, which indicates that capital is still, flowing through the system.
Right.
But hovering over all of this is this thick layer of elevated uncertainty, and that is primarily driven by volatility and fuel costs.
Fuel costs always act as this hidden tax on everything, right? From logistics down to the consumer's wallet. But I want to bypass the macro overview for a second and get straight into the granular consumer psychology. Because this is where the Eureka presentation gets just incredibly compelling to me.
It's fascinating.
The report highlights a phenomenon they were calling the trade-down economy. And I want to be clear, this isn't just about people buying cheaper things.
No, it's much deeper.
It's about a fundamental rewiring of how Americans are navigating their daily lives.
It is a calculated defensive posture by the consumer. Let's look at the grocery shift you mentioned at the top of the show.
Yeah, let's talk about the chicken.
Right. So the Beige Book literally notes feedback from grocery operators who are watching consumers walk up to the meat counter, look at the price of, premium cuts of beef, and actively pivot to chicken and pork.
Just right there in the aisle.
Right there. They aren't stopping their grocery shopping entirely. They are just substituting down the value chain to protect their weekly budget.
And what I find so fascinating is that this isn't isolated to just the grocery aisle.
Not at all.
It is bleeding into high-end discretionary experiences, too.
Yeah.
I mean, look at the restaurant shift.
Oh, this is a big one.
The report highlights that diners are increasingly bringing their own wine to restaurants and opting to pay the corkage fee, purely just to avoid the restaurant's steep alcohol markups.
What's fascinating here is that if we connect this to the bigger picture, that corkage fee anecdote is a massive red flag for the hospitality sector.
Right, because of the margins.
Exactly. Alcohol is the highest margin item for a full-service restaurant. It literally subsidizes the rising food and labor costs.
So they need those drink sales to survive.
They absolutely rely on them. When a consumer decides to pay a $20 corkage fee to drink a $40 bottle of wine they bought at the grocery store.
Instead of paying $100 for it off the menu.
Right. Rather than paying $100 for that same bottle off the wine list, they are systematically dismantling the restaurant's profitability model.
Okay, I want to pull on that thread.
Yeah.
Because I think the second and third order effects of that are wild for a real estate investor.
Oh, they change everything.
If consumers permanently adopt this behavior, it actually changes the physical footprint of future restaurant leases.
How so?
Well, think about it. If nobody is buying high markup drinks, restaurants won't need these massive sprawling bars that take up like 20% of their square footage.
Oh, that's a great point.
They won't need massive custom wine cellars built into the dining room. Landlords might start seeing tenants demanding smaller footprints or reconfiguring their spaces entirely just because the fundamental unit economics of dining out have shifted.
That is a highly perceptive way to look at it. The physical space must adapt to the economic reality of the tenant.
Exactly.
And we are seeing similar behavioral shifts in the beauty and personal care sector, too.
Oh, the salon data was interesting.
Yeah, the Fed noted that luxury salon customers aren't abandoning their high-end stylists to go to, like, budget franchise haircut chains.
Right, they still want the nice haircut.
They want to maintain their status and their lifestyle, but they are spacing out their appointments. A client who used to come in every 4 weeks is now coming in every 6 or 7 weeks.
Just stretching the budget.
Exactly. And they are dropping the high-margin add-on services like deep conditioning treatments or specialized color glosses.
It is the exact same psychology as the wine.
It really is.
They are preserving the core experience, getting the haircut, sitting down at the nice restaurant, but they are surgically removing the premium fat from the transaction.
Surgically removing it, yes.
Which brings us to the broader retail picture. Because the Beige Book notes that consumers are making more frequent trips to retail stores, but they are leaving with smaller baskets each time.
Which fundamentally contradicts the bulk buying behavior we saw a few years ago.
Like during the pandemic.
Exactly. Consumers are operating on a hyper-local, immediate need basis now. They are managing their cash flow tightly. If they only buy exactly what they need for the next 3 days, they eliminate the risk of overspending on perishable goods or, discretionary items that might catch their eye in the aisles.
So here is my read on this, and I want to see if you agree with this.
Yeah.
It sounds to me like consumers aren't hitting the brakes on the economy.
Yeah.
They aren't locking themselves in their houses and refusing to spend money at all.
No, they're definitely still spending.
Right. Instead, they are aggressively using the steering wheel to swerve around premium prices. They are still driving the car. They are just hyper-focused on dodging the margin traps.
That is an excellent analogy. The velocity of money is still there, but the direction of that money has sharply altered course.
It's just flowing differently.
Exactly. And that swerving behavior is the exact mechanism that creates the massive bifurcation we are seeing in commercial real estate right now.
Because if the middle-class consumer is dodging premium prices, all that money didn't just evaporate into thin air. It had to flow somewhere else, which dictates perfectly which retail tenants are suddenly flush with cash and which ones are staring down the barrel of a lease default.
It creates clear winners and losers.
So, based on the Eureka summary, let's dissect the winners first. Who is catching all this diverted capital?
Well, the reigning champions of this current economic cycle are necessity and value.
Okay.
Healthcare and medical tenants are a prime example. The Beige Book reports incredibly stable patient volumes and, tellingly, an increase in capital spending within the medical sector.
Well, medical makes sense as the ultimate non-discretionary spend. I mean, you can trade down from a steak to a chicken breast, but you can't really trade down a root canal or an MRI.
Yeah, you just have to get it done.
And just swipe the card. But there was another bright spot in the report that I think is deeply counterintuitive until you really look at the mechanics of it.
Which one?
Auto service and parts.
Oh, yes. The auto sector is a masterclass in reading cause and effect in real estate.
Walk me through that.
So the report explicitly notes that new auto dealers are seeing flat, and in some districts, declining sales.
Right. Cars aren't moving off a lot.
And the mechanics behind this are strictly tied to affordability. Between elevated interest rates on auto loans, high sticker prices, and then the carrying cost of insurance and fuel, I mean, financing a new car is mathematically out of reach for a massive swath of the population right now.
So the swerve there is the consumer saying, I'm going to cancel my plans to buy that 2026 SUV, and I'm just going to keep my 2017 sedan running for another 3 years.
Precisely. And when you have an entire population simultaneously deciding to hold on to aging vehicles, the average age of the national vehicle fleet skyrockets.
And older cars break down.
Exactly. Older cars require exponentially more maintenance. They need new alternators, new brakes, suspension work, regular fluid changes.
Right.
Therefore, the capital that would have gone toward a huge monthly payment on a new car is being diverted into auto parts retailers and local auto service centers. Their revenues are absolutely surging.
So, if I am listening to this and I'm looking at a rent roll for a prospective strip mall acquisition, and I see an AutoZone, an O'Reilly, or a local mechanic shop, I am viewing that tenant as fundamentally shielded from the current economic turbulence.
They are highly insulated. They are actually a beneficiary of it.
That is wild.
It's the same story with quick service restaurants or QSRs. As diners abandon the $100 full-service dining experience to avoid those corkage fees and the high menus, they still have a demand for convenience.
People are still busy. They still need to eat on the go.
Right. So they trade down into the fast casual and quick service sector, which is gaining major market share right now.
Okay, but we have to address the glaring contradiction in this report.
Oh, the luxury piece.
Yes, we have spent 20 minutes building this rock-solid case for a trade-down economy where everyone is pinching pennies, yet the Eureka presentation highlights that high-end luxury spending is completely unchanged, and in some cases it's actively growing.
Yeah, it seems paradoxical.
How does that coexist with everything we just said about people buying chicken instead of beef?
What's fascinating here is that it reveals the stark reality of a two-speed economy.
Okay.
The high-income consumer, like the top decile of earners, is simply not experiencing the same macroeconomic pressures.
They aren't feeling the pinch at the gas pump.
Right. Their wealth is largely insulated in assets, equities, high-yield vehicles. So luxury travel, high-end experiential retail, and ultra-premium goods, they remain incredibly resilient.
Oh, I see.
The trade-down effect is almost entirely a middle and lower-income phenomenon.
It's literally a tale of two different consumer bases shopping in two different realities.
Exactly.
Okay, so we've established the winners. You've got the medical clinics, the auto parts stores, the fast food chains, and then these ultra-luxury boutiques.
Right.
Now, let's look at the dark side of this swerve. If I am an investor, who are the tenants that are currently bleeding out because of this discretionary squeeze?
Well, we've touched on full-service dining, but the pain in the non-food retail sector is just as acute. Home furnishings and furniture retailers are facing immense headwinds.
That makes sense.
Yeah, the reports indicate that sales in this category are down significantly across multiple districts.
Which makes total logical sense, right? I mean, if consumers are micromanaging their grocery baskets to avoid overspending on a 3-day supply of food, they absolutely are not walking into a showroom to drop $3,000 on a new sectional couch.
Absolutely not.
A couch is the ultimate deferrable, big-ticket, discretionary purchase. You can just sit on your old couch.
Exactly. When economic uncertainty rises, durable goods are the first thing cut from the household budget. And this squeeze extends into leisure and hospitality as well.
Like tourism.
Yeah. For example, New York City contacts reported noticeably lackluster sales for mid-tier attractions, and budget hotels are finding themselves in a particularly brutal vice grip.
I want to explore that vice grip, actually, because I think the mechanics of what is happening to budget hotels perfectly illustrates the danger for mid-tier retail right now.
It's a great parallel. So the budget hotel demographic is incredibly price sensitive, right?
Very.
If a budget hotel tries to raise their nightly rate by even $10 or $15 to cover their own rising utility and labor costs, their customer base simply evaporates.
They just won't book the room.
Right. The consumer decides to stay home or maybe sleep on a friend's couch. So the hotel can't raise revenues, but their operating costs are skyrocketing.
Ouch.
Contrast that with higher-end hotel properties. The Beige Book notes that they are actually outperforming the budget segment because the affluent consumer doesn't blink at a rate increase.
So for the real estate investor listening to this, the translation is stark. The Beige Book is basically a treasure map of risk.
A treasure map of risk, I like that.
If you are analyzing a property and you see a mid-tier furniture store, a sit-down casual restaurant, and a budget hospitality concept,
Yeah.
I mean, you aren't just looking at tenants who might have a slow quarter.
Yeah.
You are looking at business models that are structurally opposed to the current flow of consumer capital.
You are looking at a ticking time bomb for lease defaults. The necessity-based tenants are positioned to maintain occupancy and absorb rent growth.
Right.
But the discretionary mid-tier tenants, they are going to fight you tooth and nail on every single rent escalation, assuming they even survive at all.
Which perfectly transitions us into the next section of the Eureka presentation.
Hmm.
And honestly, this is the part that should make every landlord sit up and pay very close attention.
It is the critical math.
Because everything we have discussed so far has been about the revenue side of the equation, right?
Yeah.
Consumer spending, top-line sales, basket sizes.
Yeah, the top line.
But a tenant's ability to survive and ultimately pay you rent is a math equation. It relies just as heavily on their expenses. And right now, the cost of doing business is fundamentally broken for a lot of operators.
This is the story of the margin squeeze. And the Beige Book doesn't just give us anecdotes here. It provides the raw, terrifying data on the divergence between what a business has to pay to operate and what they can actually charge their swerving customers.
Let's dive into these numbers.
Yeah.
Because when you see the delta between input costs and selling prices, it is staggering.
It really is. Let's use the Richmond Federal Reserve District as our case study here.
Okay.
The context there reported that manufacturing and business input price growth, meaning the cost of raw materials, freight, wholesale goods, and parts, is surging by nearly 7%.
Okay, so just to be clear, the cost for the business to simply keep the lights on and stock the shelves is up 7%.
Yes.
Now, in a normal, healthy economy, that business would just update their price tags. They would pass that 7% increase onto the consumer to protect their profit margin.
But we just spent the last 20 minutes detailing exactly why they cannot do that.
Right. The consumer is swerving.
The consumer is in a defensive, trade-down posture. If that business raises their prices by 7%, the consumer abandons them entirely.
So what happens? What is the reality?
In places like the Dallas district, businesses are reporting that they only expect to be able to raise their final selling prices by about 2.8%.
Let's really hammer this home for the listener.
Yeah.
Your costs go up 7%. Your revenue only goes up 2.8%.
It's brutal math.
That gap between those two numbers isn't just some accounting quirk. That is pure net profit being incinerated. That is a margin getting completely crushed.
Crush.
And if a tenant's margin is crushed, their ability to pay their landlord is in immediate jeopardy.
This raises an important question, though. What exactly is driving these massive input costs? Why is it 7%?
Right, where is that inflation coming from?
The Beige Book cites a perfect storm of systemic factors. First, you have elevated fuel and freight costs across all districts. Always fuel.
Right, and these are heavily influenced by ongoing geopolitical conflicts, particularly in the Middle East, which disrupt global shipping lanes.
Makes sense.
Then you have tariffs, which are artificially inflating the domestic prices of core materials like steel, aluminum, and electronic components.
And the Eureka presentation specifically highlighted surging petrochemical derivatives.
Yes, that was a key finding.
Now, to the average retail investor, petrochemicals sounds like something an industrial or oil and gas investor should care about, not them. But explain the mechanics of how petrochemical pricing directly hits a retail tenant.
So, petrochemicals are the invisible building blocks of the entire retail supply chain.
Okay.
We're talking about resins, adhesives, plastics, and fertilizers. If you're a tenant selling furniture, the manufacturer relies on industrial adhesives to build the frames.
Oh, I see.
If those adhesive costs spike, the wholesale cost of the couch spikes. If you are a retailer selling anything that comes in a plastic clamshell or shrink wrap, the cost of that packaging is derived from petrochemicals. So a spike in oil doesn't just mean it costs more for the delivery truck to bring the goods to the store. It literally means the physical box the good sits in costs more to manufacture.
Exactly. It hits them on every level. And the most universally painful cost driver mentioned across the board, one that affects both the tenant and the landlord, is the absolute explosion in commercial insurance premiums.
Insurance is just the nightmare keeping everyone awake right now.
It really is.
So these firms are trapped. They can't raise prices to match. They can't avoid the input costs. They are just absorbing the blow. The report even notes that retailers and service providers are starting to mandate inflation-indexed adjustments in their B2B contracts just to survive the volatility.
Yeah, they are trying to protect whatever margin they have left.
But here is where we need to talk strategy for the listener. If you own the physical building that this deeply squeezed tenant is operating inside of, how do you protect your yield?
You utilize the real estate industry's ultimate financial shield,
Which is?
the triple net lease, commonly referred to as NNN.
I want to spend some time here. Most experienced commercial investors know what NNN means, but I want to dissect exactly why it is so critical in this specific macroeconomic environment of 7% expense growth. Walk me through the mechanics of the shield.
Sure. So in a traditional gross lease structure, the landlord collects a flat rent check. And out of that check, the landlord is responsible for paying the operating expenses of the property.
Taxes, the insurance.
Right. The property taxes, the building insurance, and the common area maintenance, like parking lot repairs or roof patches.
Which means if property taxes jump 15% because of a new city assessment, or if the property insurance premium doubles because of a hurricane 3 states over, the landlord eats that entirely out of their own cash flow.
Correct. The landlord takes on all the inflation risk of operating the physical asset.
Okay.
But in a triple net lease, those three nets, taxes, insurance, and maintenance, are passed directly through to the tenant. The tenant pays a base rent to the landlord and then pays their pro rata share of all operating expenses on top of that.
Okay, so if the insurance goes up 30%, the landlord's base rent check remains completely untouched. The tenant simply has to write a bigger check for the expense reimbursement.
Exactly. The landlord's net operating income is completely insulated from local inflation and municipal tax hikes.
That's powerful.
It is. And the data in the Eureka report confirms that the market recognizes this value. In the Dallas-Fort Worth area, which they use as a massive case study, NNN lease structures absolutely dominate the retail landscape.
Dominating by how much?
They represent between 80% and 94% of all retail loose deals in that market.
Okay, but I have to push back here.
Go for it.
Because I think the industry sometimes treats the NNN lease like it's a magical force field, and it isn't.
No, it has its limits.
If we just establish that a mid-tier tenant's profit margins are getting obliterated by a 7% increase in their own supply chain costs, and they can't raise prices, what happens when their landlord slides a piece of paper across the desk saying, oh, by the way, your share of the property insurance just went up 40% this year?
You are hitting on the exact systemic vulnerability of the NNN model.
Right. Because the shield only works if the person holding it doesn't collapse under the weight.
Exactly.
If you pass all these skyrocketing costs through to a tenant whose margins are already crushed, you aren't protecting your cash flow. You're just accelerating their bankruptcy. The NNN lease just transfers the risk. It doesn't actually eliminate it.
That is a brilliant point, and it dictates the exact strategy 1031 exchange investors are using right now.
Tell me more about that.
This is why investors who are on a strict 45-day timeline to identify a replacement property, to defer their capital gains taxes, they are flocking to a very specific sub-asset class.
They aren't just buying any retail.
Right. They aren't just buying any NNN retail. They are buying credit-grade, necessity-based NNN retail.
Explain the difference for the listener.
If you pass a 40% insurance hike through to a mid-tier furniture store, they default and you have an empty box.
And zero rent.
Exactly. But if you pass a 40% insurance hike through to a corporate-backed grocery chain or a national pharmacy or a massive auto parts conglomerate, they have the corporate balance sheet and the inelastic consumer demand to absorb that cost without defaulting on the lease.
So the shield holds.
Right. The NNN structure only protects you if the tenant has the financial fortification to honor it.
So tenant financial health and deeply underwriting their margin vulnerability is now infinitely more important than just looking at their top-line gross sales.
Infinitely more.
You have to know if they could absorb the macroeconomic shocks, which actually leads us to one of the most fascinating structural shocks in the entire Beige book.
The labor stuff.
Yes, we've been talking about input costs and inflation, but there's a massive gravitational force warping both the labor pool and the materials market across the entire country right now.
Yes. We absolutely have to talk about the data center gravity well.
That term is incredible.
It is, because this is a phenomenon that is quietly reshaping the physical and economic map of the United States.
I love the term gravity well, because these things are acting like massive financial black holes. Let's break down the labor shortage first, because the Beige Book data here is just wild.
It's unprecedented.
The report states that employment rose in 5 districts and was flat in 7. Overall wage growth was only modest. So if you just read the headline, you would think the labor market is totally calm.
Right, it looks fine on the surface.
But when you dig into the qualitative diaries, skilled labor is practically non-existent.
Right.
Plumbers, electricians, heavy machine operators, HVAC technicians, they're just ghosts. Where did they all go?
They have been entirely absorbed by data center construction.
Just vacuumed up.
Literally, we are currently living through the largest infrastructure build-out of the modern era to support artificial intelligence and cloud computing.
And these aren't just normal buildings.
No, these data centers are not just warehouses with some computers in them. They are billion-dollar, hyper-complex fortresses that require gargantuan amounts of power, specialized cooling systems, and redundant electrical grids.
Right.
They require armies of highly specialized tradespeople to build.
There is an anecdote in the Eureka presentation that blew my mind. It notes that a severe shortage of electricians is actually delaying data center projects.
Yeah, slowing down big tech.
Think about that. Big tech companies with virtually unlimited balance sheets literally cannot find enough human beings with the skills to wire these facilities.
Right.
And because big tech can pay astronomical hourly rates to secure the labor they need, they drain the local labor pool dry. If you are a retail landlord trying to get an electrician to wire a new restaurant build-out, you can't compete.
You absolutely cannot compete. And the Beige Book highlights another critical anecdote about the labor market's underlying stress. In the Kansas City district, contacts noted that workers are willing to switch jobs for as little as $1 an hour more.
I want to linger on this because it seems like a throwaway line, but it's actually a profound psychological indicator.
It really is.
Changing jobs is annoying. There's friction. You have to learn a new commute, read a new boss, figure out new HR systems. In a booming, comfortable economy, nobody jumps ship for an extra $40 a week before taxes.
Exactly. If we connect this to the bigger picture, it is the trade-down economy manifesting in the labor market.
Oh, that makes sense.
Overall, attrition rates, like people quitting jobs en masse, are low. But the fact that skilled workers will endure the friction of changing employers for a mere $1 an hour bump reveals how desperately tight household budgets are right now.
The margin is that thin.
The compounding pressure of grocery inflation, utility costs, and auto insurance is forcing the working class to chase every single micro advantage they can find.
So they are swerving in the grocery store for cheaper chicken, and they're swerving in the labor market for an extra dollar. And before we move off data centers, we have to touch on AI. You can't mention server farms without addressing artificial intelligence. Is the Fed seeing AI displace workers yet?
The qualitative feedback is incredibly nuanced here. Businesses are absolutely integrating AI at a rapid pace.
Right.
But they are primarily using it for hiring screening, back office productivity, and reshaping workflows. Crucially, the local contacts are not reporting that AI is causing mass displacement of human labor.
So it's not replacing people yet.
Exactly. It is acting as a tool to augment existing staff rather than a catalyst for mass layoffs, at least for now.
Okay, so the AI isn't replacing the workers yet, but the physical data centers are absolutely displacing the raw materials needed for commercial real estate.
Big time.
They aren't just hoarding the electricians, they're hoarding the physical stuff.
Consider the anatomy of a data center. They require staggering quantities of structural steel, miles of specialized copper wiring, and massive electrical transformers.
Just tons of it.
Because these tech conglomerates are purchasing these materials at such an unprecedented global scale, it creates a massive supply vacuum.
Which artificially elevates the cost of construction materials for everyone else.
Right.
If you are a retail developer and you want to build a simple 20,000 square foot strip center in the suburbs, your cost to acquire steel and transformers is being dictated by the fact that you are bidding against a trillion-dollar tech company that needs those exact same materials for a server farm.
And that dynamic makes new retail construction incredibly expensive. In many secondary markets, it makes new construction mathematically impossible.
The numbers just don't work.
The numbers simply will not pencil out. But this leads us to the hidden gem within the Eureka presentation. This is the strategic playbook for how a retail investor can actually weaponize this data center boom for their own profit.
Let's hear it, because if I can't build, how do I win?
Because data center construction is so robust and takes years to complete, it fundamentally alters the local demographics of whatever area it touches.
No.
It brings thousands of transient, highly paid tradespeople into specific, often suburban or rural geographic corridors.
Right, they all have to travel to the site.
These massive workforces have daily needs. They need to eat lunch, they need to fill up their trucks with gas, they need to buy coffee in the morning, and groceries on their way home to their temporary housing.
The report calls this defense and data center adjacent retail. And I love this strategy. It is the purest application of the gold rush mentality.
Yes.
You don't necessarily need to own the gold mine, the billion-dollar server farm, to make a fortune. You just want to be the person selling the pickaxes, the boots, and the sandwiches right next to the mine.
Precisely.
You want to own the QSR pad site, the convenience store, and the auto parts store on the main highway leading to the data center construction site.
It is a brilliant demographic play. You are positioning necessity-based real estate directly in the path of a massive, heavily capitalized demographic shift.
Let them bring the people.
Exactly. You let big tech spend the billions to attract the workforce, and you capture the daily consumer spend of that workforce.
To see all of these national macro trends, the inflation, the labor shifts, the construction costs, converge in real time, the Eureka report zeroes in on one specific, highly active market as a case study.
Right. District 11.
Let's spotlight Dallas-Fort Worth, which is the 11th Federal Reserve District.
Eureka Business Group is headquartered in Texas, so they bring a very sharp, hyper-local analytical lens to this specific district.
They know it intimately.
And the data shows that Dallas is fundamentally outperforming the national averages. While the broader U.S. economy is seeing slight to moderate growth, the 11th district is experiencing moderate expansion that is noticeably more robust.
The employment numbers stood out to me here. The staffing firms in Dallas reported that June was their best month since before the pandemic.
That's huge.
And is a massive indicator of corporate confidence. And wage growth expectations are higher there as well, right? Yeah. The report cited a 3.5% expected wage growth over the next 12 months.
That is correct. But the true value of the Eureka presentation is how they layer their own proprietary market data over the Fed's Beige Book findings.
The index, right?
Right. They introduced the Eureka Retail Velocity Index, which scored a 5.3 in June. And what this index reveals is that Dallas is operating as what they call a two-speed market.
Okay, break down the mechanics of the two-speed market. What exactly is moving in the fast lane and what is stalling out in the slow lane?
It revolves around a massive flight to quality. Historically, the commercial real estate industry uses that term to describe the office sector, right?
Like leaving old buildings for new ones.
Yeah, law firms leaving aging, Class B office parks to lease space in brand new Class A glass towers with high-end amenities. But right now, we are witnessing a severe flight to quality in the retail sector.
So what does a Class A retail asset look like in this environment?
The fast lane of the market consists of well-located, meticulously maintained suburban assets in high-growth demographic corridors. If you look at the markets north of Dallas, places like Salina, McKinney, Keller, these retail centers are highly coveted by tenants. They offer excellent ingress and egress, modern facades, strong co-tenancy.
Right.
Because of the demand, these assets are commanding massive premium rents, anywhere from $36 to $71 per square foot.
$71 a foot for suburban retail is staggering.
It's incredible.
It shows how desperate high-quality tenants are to secure prime locations.
Mm-hmm.
So if that is the fast lane, what does the slow lane look like?
The slow lane is the older, secondary product in less desirable locations.
Yeah.
Think of the 1980s strip mall with deferred maintenance, a crumbling parking lot, and obsolete HVAC systems.
Right.
These properties are facing insurmountable headwinds.
Because it's a replacement cost issue we talked about earlier.
Exactly. Let's connect the dots here. Because data centers and infrastructure projects have driven the cost of steel, copper, and skilled labor to the moon, the owners of these older secondary properties simply cannot afford to renovate them.
The map doesn't work.
If a new tenant demands a $50 per square foot tenant improvement allowance to update the space, the landlord doesn't have the capital to fund it because the construction bids come back twice as high as they did 4 years ago.
And simultaneously, because tenants are so hyper-focused on maintaining their own tight profit margins, they refuse to locate in a subpar center that doesn't guarantee foot traffic.
Right.
So the secondary properties are left stranded. They can't afford to upgrade, and they can't attract tenants as is. They just stall out, while the Class A properties absorb 100% of the market demand.
Which brings us to the ultimate conclusion of this deep dive. We have analyzed the diary of the economy. We understand the consumer psychology, the margin squeeze, and the construction constraints.
We have all the pieces.
Now, we have to translate all of this data into an actionable investor playbook. What should you, the listener, actually do with this information today?
Well, the first and arguably most powerful strategy in the Eureka playbook relies entirely on those construction constraints. It's the play on rising replacement costs.
Yeah.
Explain the mechanics of why buying existing assets right now is such a massive value play.
Because new construction is so prohibitively expensive, existing well-maintained retail centers are currently trading in the market for less than their physical replacement cost.
Walk me through a hypothetical to make this concrete. How can a building be worth more than the market is pricing it at?
Imagine you are underwriting a high-quality 50,000 square foot grocery-anchored center. Based on its current net operating income and the local cap rate, the market prices that asset at $10 million today.
Okay, $10 million to buy it.
But if you tried to replicate that exact center, if you bought the raw land, poured the concrete, bought the inflated steel, fought the data centers for the copper wire, and paid the premium labor rates, it might cost you $14 million to build it from scratch.
So that $4 million gap is the replacement cost premium.
Exactly. When you buy that existing asset for $10 million, you're acquiring it below its intrinsic physical value. Furthermore, because no developer can afford to build a competing center across the street for $14 million and charge low enough rents to steal your tenants, your existing asset has a massive structural moat around it.
A huge moat.
Supply is artificially constrained, which guarantees long-term occupancy and rent growth for existing Class A owners.
You are basically buying the building for less than the sum of its parts and getting a monopoly on local supply thrown in for free.
That's the play.
What about the capital markets, though? Is there actually debt available to execute these acquisitions?
The Beige Book confirms that the lending environment is stabilizing. Commercial loan demand is growing modestly. Regional banks are reporting that businesses and sponsors are finally moving ahead with delayed projects.
So the money's there.
The capital is absolutely available, provided you bring institutional quality underwriting to the table. Lenders want to see that you understand the tenant's margin risks.
And what is the specific advice for the 1031 exchange investors listening? The people who just sold an asset have a ticking 45-day clock to identify a new property and are terrified of making a mistake in an uncertain economy.
The primary directive is this. The economy is still expanding, capital is flowing. This is not the moment to panic, sit on the sidelines, intentionally fail your exchange, and take a catastrophic 20 to 30% tax hit on your equity.
Right, don't just eat the tax.
You must deploy the capital. However, your underwriting criteria must radically shift. In this environment, tenant credit quality and necessity-based utility matter infinitely more than the going-in cap rate.
I really want to emphasize this because retail investors can get so easily blinded by the promise of high yield. You are saying to prioritize the tenant's business model over the initial return on paper.
Absolutely. Consider the trade-down economy we've analyzed. If a broker brings you an off-market deal for a strip center priced at an attractive 6.5% cap rate, but the rent roll is filled with a mid-tier furniture showroom, a struggling sit-down restaurant, and a boutique fitness concept,
No way.
that 6.5% yield is an illusion. It looks great on a spreadsheet today, but those tenants are directly in the crosshairs of the consumer discretionary squeeze.
Right, when their input costs go up 7% and you try to pass through an NNN insurance hike, they default. And your 6.5% cap rate instantly goes to zero.
Conversely, if you find a center priced at a lower 5.5% cap rate, but it is anchored by a corporate grocery store, a national auto parts retailer, and a thriving urgent care clinic, you take that deal every single time.
Because they survive.
Those tenants capture the swerving consumer. They have the margins to absorb inflation. The 5.5% yield is durable. It will actually pay you rent next year, while the 6.5% center sits vacant.
That is the definitive playbook. But as an investor, your job isn't just to look for the upside. Your job is to obsessively map out the trapdoors. We have to look at the dark clouds in this report.
Yes, the warning signs.
What are the systemic risks that the Beige Book is flashing red about?
The most alarming signals in the entire document center around severe consumer credit deterioration at the lower end of the economic spectrum.
Okay.
The Fed context report that low and moderate income households are increasingly exhausting their savings and are now funding essential daily goods with credit cards.
They aren't putting flat-screen TVs or vacations on plastic. They are putting milk, bread, and utility bills on 24% interest credit cards.
Right.
That is a mathematically unsustainable survival tactic.
It is the definition of systemic fragility. And the Eureka presentation highlights a couple of specific qualitative anecdotes that are genuinely jarring to read. A nonprofit organization in St. Louis reported to the Fed that their demand for meals jumped 30% in a span of just 2 months.
30% in 60 days. That isn't a gradual trend. That is a sudden structural collapse of household budgets in that demographic.
And even more starkly, a nonprofit in the Dallas district reported that the current demand for food assistance in their community actively exceeds the peak levels they saw during the COVID-19 pandemic and exceeds the levels seen during the great financial crisis of 2008.
That is heavy. That reveals a deeply stressed, fractured consumer base operating in the shadows of an economy that claims to be moderately expanded.
Yeah, it's hidden under the surface.
And this financial distress isn't just isolated to the urban centers, right? The report extensively details agricultural stress as well.
Yes. The agricultural supply chain is under immense pressure. Row crop farming, specifically, is facing a brutal financial squeeze.
What's driving that?
They are dealing with lower global commodity prices for their crops, while simultaneously facing those exact same surging input costs we discussed earlier. Remember the petrochemical?
Right, the fertilizers and the diesel fuel to run the tractors.
Exactly. When the farmers' margins collapse, it disproportionately devastates the retail economy in rural and small-town markets, particularly in massive agricultural states like Texas.
Right.
The rural consumer is feeling the exact same vice grip as the urban budget hotel consumer.
So I have to ask you the million-dollar question, because this is the ultimate risk factor for retail investors.
Let's hear it.
We spent the first half of this deep dive establishing that value and necessity retailers, the grocery stores, the auto parts shops, the fast food joints, are thriving right now because the middle-class consumer is trading down into their stores.
Right, they are catching the diverted capital.
But if the lower-income consumer, the traditional core demographic for those value brands, is hurting this badly, putting food on credit cards, relying on food banks, does that pain eventually trickle up?
I see what you mean.
If the bottom falls out of the consumer market, do the value retailers eventually collapse too?
It is the most critical systemic risk to monitor over the next 12 to 18 months. Right now, as you noted, the balance sheets of these value retailers are being artificially buoyed by the influx of middle-class capital swerving into their ecosystem.
Right.
But there is a tipping point. If the lower-income consumer exhausts their credit lines entirely and falls out of the transactional market, if they can no longer afford to buy even the cheapest goods, the total volume of sales will drop.
The middle-class influx won't be enough to subsidize the loss of the core demographic.
Precisely. The value retailers would face their own revenue crisis. It is a highly precarious balancing act, which is exactly why reading the qualitative diary of the Beige Book is so vital.
You can't just wait for the lag data.
You cannot wait for the credit card default statistics to hit the Wall Street Journal. You have to track these local, anecdotal shifts in food bank lines and dollar store foot traffic to predict the defaults before they materialize in your rent roll.
It all comes back to the diary. You have to know what the artist is feeling while they paint the picture, not just critique the canvas when it's done.
That's a great way to put it.
So let's pull all these complex threads together for the listener. If you are a commercial real estate investor digesting this July 2026 Beige Book analysis, courtesy of Eureka Business Group, here is your executive summary.
Let's do it.
The national economy is still growing, but consumers are actively, aggressively trading down to dodge premium prices.
Right.
The margin between a tenant's operating costs and what they can charge is razor thin. Therefore, credit grade, necessity-based, triple net retail properties are the absolute safest harbor for your capital.
Absolutely.
And finally, because data centers are consuming all the physical construction materials and skilled labor existing high-quality Class A, Retail assets are incredibly valuable because they are virtually impossible to replace at their current market pricing.
That is the perfect distillation of the macro environment. You want to acquire existing physical assets anchored by essential tenants, insulated by NNN lease structures.
Here's where it gets really interesting, though. Something for you to mull over the next time you're staring at your cap rate spreadsheets.
Oh, I'm intrigued.
We spent a lot of time analyzing the data center gravity, well, how they act like black holes, sucking up the tradespeople, the steel, the copper, and fundamentally altering the cost of development.
Right.
But let's extrapolate that out 10 years. If massive digital infrastructure projects are dictating where the labor force migrates, where the massive capital flows, and consequently where the defense-adjacent retail booms, will future real estate investors entirely abandon the old metrics of growth?
But what do you mean by old metrics?
Well, historically, retail developers track residential housing permits. You look for where the new subdivisions are being built, and you put a grocery-anchored strip center right at the entrance of the neighborhood.
Classic strategy.
But if the physical footprint of the digital world is becoming the new center of economic gravity, are we entering an era where you shouldn't track housing permits at all? Are we entering an era where you exclusively track where the fiber optic cables and digital infrastructure are being poured? Could a humming billion-dollar server farm actually become a more reliable, more lucrative neighborhood anchor for a retail center than a grocery store?
It is a profound paradigm shift to consider. We are watching the physical, concrete architecture of the real estate market actively reorganize itself to support the invisible architecture of the digital economy.
Exactly.
The investors who recognize that gravity shift first are the ones who will capture the generational wealth.
Just a little light macroeconomic theory to keep you up at night. A massive thank you to Joseph Goslan and the Eureka Business Group for doing the heavy lifting and compiling this incredible data into such an actionable format. And thank you, the listener, for joining us on this deep dive. Until next time, keep reading the diary.